Hello investors, and in today's video I will do the Cisco stock valuations. So basically I will calculate the intrinsic value of the stocks using the three models: the net profit model, enterprise value model, and the free cash flow model, and check the liquidity of the stock as well. But before we do that, we'll do the revenue diversification to see how the company is doing in terms of the revenue and so on, right? Okay, so let me do the quick introduction to myself. Myself is Pramod Kumar. I am a CFA charter holder and FRM certified. This is my website, and in my channel I do the stock valuations based on my interest and also based on your recommendation which you have put from time to time in your comments. So I have a list growing, and I'll based on my time I'll do that. So okay, so that's about me, and if you like this video you can subscribe and give a thumbs up. I really appreciate if you give a thumbs up. So let's get started without further delay. Okay, so let's go to the revenue diversification. So if I see on the revenue side, there you can see the revenue is coming from their two kind of streams. One is from the product and other is from the services, and these are in the billion. So if I see the past 3 years, the revenue from the product is increasing and the revenue from the services is increasing, but a little bit. But overall the revenue is increasing from 48 billion to 51.9 billion dollars, right? And these are in US dollars. The overall, if I see from the category wise, there's some of the revenue, mostly the revenues from their platform, which is their core main business, from the enterprise side, and some is in their security and services side as well. Overall, from the geographical segment I see, which is I like it, that they are pretty much not only in America, but they have a good presence in EMEA and APJAC region, Asia Pacific region basically, right? So that pretty much is a global brand. Cisco is a global brand. Let's see from the capital allocation perspective. So from the cash, the major of the cash is deployed to the share repurchase. So even if nobody bought it, so seems like the company is continuously buying their shares. So if you see their shares in the diluted from 5.00 billion to 4.43 billion in 2019. So they have pretty much diluted a share a lot. The dividends is 19%. They issue again, so 67. So it seems like most of them, the company is doing pretty good. Only 4% is used for debt payment, and most of the, if I 60, 70, 79, 86% seems like the cash coming back. So this is the pure gold, right? Either from the share repurchase perspective or either from the dividend. So that's mostly, and rest only 4%. So seems like company is self-sufficient to run even from the small capital perspective, and only 3% is primary use for the investment perspective. Wow. So that's the power, right, of the bigger brand. And dividend per share is also increasing, so it's, as you can see here, so this is a pretty good slide. If I do, okay, so this is pretty much same. Okay, sorry about that. Okay, so on the return perspective, if you invest in this stock $100 in 2014, that same amount of money will, this is a Cisco stock, and is comparing with the S&P 500, which is a broad-based index, or the technology index, which is closely related to the Cisco sector, right? So it beats both, little bit from the green, which is the S&P IT sector index. It's a little bit above, but from the broad-based index, you can see it's much better if we invest in Cisco rather than on broad-based index. So that's what is highlighted based on the past 5-year data, and this includes the reinvestment of dividend as mentioned here. Okay, so we have a good overview. Let's quickly check the total return, and then I'll show liquidity, and then we quickly comes up to the net profit margin. Okay, so from the total return perspective, I have taken the 10 years of the data. Here I am showing the top 3 returns, which is the return on investment capital, return on equity, and return on assets. So we can see from the return on investment capital is from 12.69% to pretty much double, 24.97%, which is way good, right? Which is shown in the blue line. So this is the return on investment capital. Return on equity pretty much for sure, because they are buying back the equity, so it's also jumped in 34%. It's also double as compared to the 10. There was a big dip in 2018, but overall it's pretty good in other years. The return on assets is also keep consistent from pretty much almost 10 to little bit shy to 12%. So overall the is pretty good in terms of let's double quickly check the liquidity. So how the company is doing in terms of liquidity in during this time, because we don't want invest in the company which has like a credit or cash crunch, right? So pretty much I don't expect that, because how the company is buying and doing the dividend, issuing the dividend, increasing the dividend. So but we always have to double check. But so far, if you like the video, don't forget to give a thumbs up. It will suggest Google that is a nice video and promote more video. I really appreciate, and it motivates me if you click a subscribe button as well if you are new to the channel, to make these kind of videos from my busy schedule. Okay, so on the liquidity side, anything above 1 is good and pretty much is clearly over 1. So 10 years ago it was 2.5, way above it's required, and even now it's above 1, 1.05 and 1. So it's pretty good. Okay, sorry about that. So let's get started from the pricing. So let's see whether what we get from the our price. So let's get started. In this one, I'm using the first model to predict is the net profit model, and then I will use the enterprise value, and the third one is the free cash flow model. And based on all three models, I equate and then come up with my intrinsic value of the stocks, right? So that's the overall what agenda is now. All three models. If you are new to the channel, let me know that I'll take the 10 years of the data, and also project the next 10 years based on the some input which is shown on the screen, and I'll go over that as well. Okay, so as you can see, the top line in revenue is grown by 2.63% for the last 10 years. Year over year, and the net profit margin is increased by 4.11% for the last 10 years, right? So I have used although in the recent past, it is 5 years, we can see the net profit margin increase. So this means company has more efficient now in terms of increasing the bottom line, but I'm being a little bit conservative and already also take the 4.11 as a profit margin. But as a long term, I take the 2%. So what I assume every year I am a little bit conservative and dropping the rate, right, little bit, and comes to the 2%. So every year I'm dropping a little bit, and then for the 10th year I say, okay, now the company grows at the rate of 2. Some people say, okay, why not 2.5? But let be conservative rather than sorry later, right? So, and if you can see the current PE right now, the stock is 17.57, which is way lower than the industrial PE. So with just looking at the PE right now, seems like the stock is undervalued. Let's see how my intrinsic value come as well. So okay, so I have this growth rate, so I simply applied the growth rate to the net profit and project the growth rate for the next 10 years, and then discount required return is I take the 10% required return. So for 10%, using 10%, then I just discount this for the next 10 year and come up with this present value. If I sum it with my market value in millions, is come as $204 million, and then I divide it by number of share outstanding to come up with my per share of my own intrinsic value using this model. If I do that, I come up with the $48.38. So this is from my first model. This is the value. Okay, so let's go to the next one. So next one is the enterprise value model. This is more useful when you're trying to buy the whole the company, but this is another good model to use. So enterprise value, if I see from it comes the year over year, again I have taken 10 years, and then I have also taken the EBITDA, which is the operating income interest before interest and tax and depreciations. So that's, if I take both, this is the quick check here, rather than me to talk a lot, so you can quickly see this chart if you're new. Usually my existing YouTube user who is watching my channel, they already know where to look in the informations. So the enterprise value is very good, increase almost 10.5 and 10, and with the recent 5 years is 10.9% year over year increase. Same thing with the EBITDA is also increase, and the very good thing about debt is negative, so they are reducing the debt, right? So this is good from the increasing the value but also decreasing the debt. Okay, so same thing, then I'll take the, if I take the current enterprise value, which is higher than the average, but overall it's low. And just to highlight, if you haven't seen that, if I quickly see the enterprise value over EBITDA ratio, which is increased from 8 to 15, although my enterprise value is also increased, but my EBITDA doesn't increase that much, but it's not that bad. It's 15. I expect if it's 10 or low, it's much better, but still okay. So what it's trying to say is, if you buy the company as a whole, it will take you at least 15 or 16 years to get your the company to come up with that amount of money, right? On the debt side, it's a little bit higher. If I say debt over EBITDA, so seems like, but I believe for the next few years, it's decline from 1.42. It's, you say it was lower, reduce, increase, and then it started decline. So I expect this ratio to be decline, but it's still not bad. Okay. So their debt is over 1.4 times right now with as compared to their operating. So right, so that's, you can think from this ratio. Okay, so I use the EBITDA and take the rate of 10-year, which is even a little bit lower than 5-year, but is again a bit conservative, and also dropping this to 2%. So when I does this, do the EBITDA growth for the next 10 year, again I take the 10% required return, and each EBITDA I discounted for each year, and then come up with this forecasted my enterprise value. I adjust this sum with the average debt and the current cash to come up with the enterprise value. And it is simple math, maybe I can show it. So the sum of this one minus debt and plus the cash. Okay, so divide this by number of share outstanding. So the next one gives me the $64, right? So this means this, according to this model, now it's saying, okay, your price should be 64, which is a little bit higher as compared to the from the first model, which is from the income statement perspective. Let's take the free cash flow, which is a little bit more on the conservative side. So see what it comes. Okay, so free cash flow, how I calculate, I'm showing it here as well, just to be a little bit more transparencies. So I have taken the operating cash flow and then subtract the capital expenditure, which is pretty much 3 to 5%. That's what the company claims. And then come up with this free cash flow. Simple enough, right? So for the 10 years, if you see the free cash flow, again, it's growing. So I really like one thing, and that free cash flow is growing, income is growing, debt is reducing, operating income is increasing. So company is a very long history. Like Cisco is an enterprise-wise company, and it has a very long history. And I really like that the way company can able to increase the bottom line and increase the cash flow, right? So again, I have taken the 5% growth rate, and that 5% growth rate, I am dropping that to 2% for the next 10 years. Okay. And then I increase the free cash flow based on the these growth rate. So for the next 10 years, and then I assume that I'll sell the company at the rate of 15 PV, right? After 10th year. So that's why it's 315. Again, for that, with the 10% required return, I have taken the present value of these all free cash flow to come up with the market cap in million is $218 million. Okay, so next is then I divide, and with this model I'll come up with $51, right? This is my third model my pricing is, which is looks a little bit. Now I have all three models. Let's say what is my price. And first model, it is 48, second is 64, and third is 51. So pretty much I give almost equal weight to all to come up with 100% weight. And if I multiply this intrinsic value to the weight to come up with the price, so this is my individual weight price, and then I have this, my price is $54.64 as compared to the market. This is $47.77. So pretty much the share is, and I do believe the share is below of our price, right? So our price, if I add further even the so this is my price. Okay, so what you think about it? And so this is the price what I get from the model, and I think right now the share is dropping below. So let me know what you think about it. Do you think do you want to buy, or do you want to consider any other company? Please put in the comment, and if you're new, do subscribe to the channel, and let me know if you think is a good time to buy with this price, or you think you want to have any other options and you want me to cover any other video. Thanks for watching, and hopefully see you soon in another next video. Bye for now.